India's bond market is on fire. In 2023, foreign investors bought 598 billion rupees worth of government debt. That's about $7.2 billion, the highest amount since 2017. So why the surge in inflows? One reason is global investment bank JP Morgan's announcement that it will include some Indian bonds in its emerging market government bond index.
The reason that is key is there's over $300 billion that tracks that index, and India, given the size of its market, which is huge, it's a $1.5 trillion government bond market, $2.5 trillion overall, it will have a 10% weight in that index. So you can imagine what that means for flows. Very passively, $30 billion. We think there'll be other index companies like the Bloomberg Barclays Global Aggregate Index that will also want to include India later down the line. So when you line up all those things, index inclusion, monetary policy easing, strong fiscal performance, and the fact that this has been one of the strongest performing bond markets, over the last decade already, you can see the reason why investors are key to start, looking at and investing in Indian bonds.
Outside the bond market, investors have been pumping money into these stock markets. Global investors bought $21 billion worth of Indian shares in 2023. According to Bloomberg, it's the largest total in 3 years.
Our preference actually for the next 6 to 12 months is more of a barbell strategy. So we like the cyclical sectors like industrials and discretionary, consumer discretionary. So industrials, we think, will benefit from the government's plan in terms of the capex and infrastructure spending. That's ongoing. Consumer discretionary, as real income continues to grow, we think that will continue to benefit the sector. And then on the other side, being more defensive, we have healthcare. So it's part of our barbell strategy.
Strong investor interest saw the Nifty 50 hit a fresh record high this year. The benchmark index ended 2023 with a gain of 20%, marking its 8th straight year of positive returns.
The India opportunity is one that's being looked at across institutional and retail. The growth story in India with regards to not only the GDP, which is growing at an annualized rate of about 7%, but also in terms of earnings growth of underlying economies, the rewiring of global supply chains. And also the demographics have been a big story as well with regards to the percentage of working age population there. Again, that is a big contrast to some other markets where you start to see a deflationary environment and also demographics kind of going the other way and decelerating growth. India is now being looked at as a primary growth driver from India, and that's kind of moved away from China.
But having growth potential is just one side of the story. The practical reality is that it's not easy to invest in India as a foreigner.
I think one of the most easy and simplified ways to actually get a broad exposure to a broad range of Indian equities, for instance, is actually via ETFs. So ETFs are a relatively low-cost way to gain exposure, and one of the largest ETF out there in terms of its asset under management or its AUM is actually the iShares MSCI India ETF.
While the Indian stock markets have made impressive gains, for investors outside India, a depreciating rupee could also crimp gains.
Historically, India always has a twin deficit, even until now. So this twin deficit here refers to the fiscal as well as the current account deficit. And essentially this means that more of India's currency is actually leaving the country. And this could actually cause people to not be too confident about India's local currency. So over the last 5 years, on an annualized basis, the Indian rupee has actually depreciated at an annualized basis of around 4% compared to the SGD. So let's say if I'm investing in the Nifty 50 index, which is a common benchmark Indian equity market index, for instance, on an annualized basis, in terms of your local currency terms or your Indian rupee terms, I'm actually making about 14.7%. But when it comes to SGD terms, because of this currency depreciation, I'm only making 10.4% on an annualized basis. And over a longer term, let's say over your 5-year period, I'm making about 98% in terms of the price returns when it comes to the Nifty index in Indian rupee terms, but in SGD terms, I'm only making about 64%.
But there is a silver lining in the rupee's performance.
The rupee is one of the least volatile currencies in the world. The 1 month implied volatility has been around 2 to 3%. And so what that means for an investor in the bond market is not to say you can't experience depreciation, but typically it's nowhere near enough to wipe out the returns you're getting from the underlying bonds. And that's against the US dollar. If you're an investor in Singapore dollars, because there tends to be correlation between something like the Sing dollar and the rupee, or for a global investor, maybe euro and the rupee, the returns from those currencies tends to be even stronger, because if the rupee is depreciating, probably the Sing dollar and the euro are depreciating as well.
For most investors that are hedging back their exposure, it really more is about the volatility. As long as the volatility remains relatively muted, I don't think it's a huge concern for most investors.
Currency risks aside, the upcoming elections and any potential spike in oil prices are some of the other concerns that investors need to pay attention to.
India is going to have elections later on this year. We do expect continuity. We do not think there will be much change there. Policies are going to be continual. So, but that is something to watch out for because it is an election. But the valuation is one thing that I mentioned. India tends to be much more expensive than other parts of Asia. So it's a relative game. If other parts of Asia becomes more attractive, if growth stabilizes in China, you might see funds coming out of India into other parts of Asia. Last thing I'll mention as well is that India is an oil importer. It's a net oil importer. So to the extent that we see any spike in oil prices, and that will be actually a headwind for the Indian economy.